Hi again, it's Chris Cordoba here, founder of California Retirement Advisors and certified financial planner. I'm reaching out today on behalf of our entire team, potentially your financial advisors that you're working with, in order to share a little bit of information of what's been happening in terms of this SVB, Silicon Valley Bank, and the fact that they were closed by regulators and now the FDIC insurance has taken over that bank. Likely you've heard about this by now, but I thought it was worth sharing with you a bit of an important update on things that I would want to know about if I was the client in terms of how it pertains to me. So as we get into this, we aren't going to get into all the minutiae pertaining to what's happening with the bank, but rather a few things I think are helpful for you to think about today and what you should know. As always, it shouldn't be considered investment advice or tax advice of any kind. I have the responsibility to share this with you. Please speak with your financial advisor or myself before acting upon any of this information. Okay, so here's what the agenda looks like. First of all, what's happening and why should I care? I think that's always a great way to approach things. What does it have to do with you, in other words? How does this affect you and your investments? And then what can I take away as an action plan to protect myself or even benefit in the future? We'll have a few ideas at the end of a few proactive things that you could start thinking about going forward as a result of all this. Okay, so like I said, by now you've heard what's happened in the news. There's developing stories on this as we speak. There was another bank that was pursuant to Silicon Valley Bank, Signature Bank, which is a smaller but still a sizable regional bank that was here in California, in fact, as well. So the main concern that we were worried about over the weekend, at the very least, is what were the regulators going to do? What was the government going to do in terms of stepping in and helping this just be a trickle-down effect into other banks and therefore becoming a run on not just one bank, but a run on multiple banks like we had in the 1920s. Could be potentially devastating if we lose the faith in our banking system and everybody goes to take their monies out of each of the banks. And so that's what took place. The start of that took place with Silicon Valley Bank. I'm going to give you a little bit of an update as far as what happened there, and we'll share with you a little bit more into how to think about it in just a moment. Okay, so for starters, one of the things that I'll share with you here is, and I think on the bottom left-hand side, you can't see that, but it says the dollar value of bonds, and on the right-hand side of the teeter-totter, see interest rates. Now, this is something that we've spoken to all of our clients about for many numbers of years because the interest rates have been very, very low, and there's a lot more room for the rates to have gone up than there would have been for them to have gone down. So this concept shouldn't be new. But what we're seeing happen here is it's happened not just at the individual level, but now more at a bank level or institutional level. And so the main concept here is that these have inverse relationships, interest rates and bonds. If interest rates go up, value of bonds go down. If interest rates go down, the value of bonds go up. And I'll spend just a quick moment on this, and this is relevant in just a minute. Just bear with me. I'm going to get into it as to how it applies to Silicon Valley Bank. But a little bit of a primer on why this works in this manner is just to think of it from yourself buying a 2-year government bond. And let's say you just bought this at the start of the year on January 1st, and you bought it at 4%. And today the rates are 5%. So somebody else goes to buy a 2-year bond as well, and you're thinking of selling your 2-year bond because you might want to utilize that money to buy a house or something. And you think, I'll put mine out there for sale and see what I can get. Well, at that point, why would the new investor that's going in to buy a 2-year bond buy your bond at 4% when they can get a brand new one at 5%? So I know a lot of you know this, but not everybody understands this, or it's been explained. So please understand the very simple concept is that if this were to occur and the rates were to go up on new issues, on new bonds, and you own a bond that is going to be locked in at a lower rate, you would need to make some provision, provide a deal of some sort, so to speak, in order to give somebody else an incentive to buy your bond. And that usually comes in the form of a discount of the price. The discount of the price is going to become an offset to the yield that that other investor would have otherwise received if they would have bought the 5% interest bond instead of the 4% interest bond. So hopefully that makes sense. And this applies to all of your bond investments as well. So it is relevant, but I'm explaining it here as a primer to why it made a difference to Silicon Valley Bank. And this is just a quick graph of what happened with that 2-year bond. It's been many years since we've seen it up to 5%. That hit that spike. There were concerns that if that 2-year hit the 5%, we were going to have some additional problems, and it did. And this is potentially one of the fallbacks that took place as a result of that. We saw it dropping there to 4.6 on Friday, and it's down, I believe, as far as 4% now already. So within one day, here as a 1% drop. It's just crazy how much the bonds themselves have been fluctuating in yield. Okay, so I'm also going to share with you a sample of a balance sheet from Silicon Valley Bank. This is something that is just very high level on their balance sheet, and actually it's been simplified a little bit just to give you some perspective on what this may look like. But you see on the left-hand side what they owe, and on the right-hand side what they have. And you see the customer deposits on the left-hand side as far as what they owe. Even though they're deposits, these are not dollars that the bank has the ability to just keep for themselves forever. They have to give the money back to the customers if and when they want the money. It's not generally the case that all the customers want the money back at the same time, but we'll get back to that in just a moment. So you've got those deposits. Now, the way that the bank is going to make a good portion of their money is they're going to utilize that deposits to make other investments, and those investments oftentimes will come in loans or buying other securities where they can make some additional dollars. They're essentially utilizing the deposits on hand in order to do other things with their own other customers where they can make a margin on the dollars that you will have deposited. So when we're looking at the right-hand side, what they have, we can see that the combination of cash and those dollars available for sale amounted to about $40 billion of the $208 billion. And the other dollars below that are likely things that they wouldn't have had available to sell. Now, $40 billion seems like a reasonable amount. I'm not going to tell you that that wasn't enough. That's not what I'm here to do today. But this is an S&P 500 company, and they go through regulations. So I'm guessing to some extent that this was a reasonable amount. But there's a little bit more to the story because they could invest these securities a number of different ways. And also the type of customers that they have also plays a part. And in order to share that with you, I'm going to give you a little bit more of these 6 factors I think are worth knowing about. First, and maybe this should have been the 7th factor I would have added in, but it's important to understand the type of bank that this was catering to. If you haven't heard already, they're essentially catering to venture capital startup firms, smaller companies. These are companies that are generally considered to be higher risk, but to their credit, they cater to these companies. I'm assuming quite well because they developed a reputation for getting even more companies to bank with them and with sizable deposits at that. So I don't know enough about that to tell you whether they were providing a great service or not, but just that they've created a niche, and the niche sometimes can work to your disadvantage because if you have all one type of client and you just basically are depending upon that type of client, then their actions collectively can come back to hurt you if you haven't thought about other ways to diversify your client base from a business perspective, I guess is how I would see it. So you've got that as a primer. Now, what's happened with the economy, as you well know, in general, before this has come up, is that the economy softened up. People have concerns. There's a lot of uncertainty out there. So investments in general have slowed down, but investments in higher risk, smaller companies, venture capitals, and the deposits associated with them have also slowed down. So in the meantime, these companies still needed to have payroll. They're still operating and developing and doing important things in whatever their business might be. And but since there's the less of infusion of dollars coming in, that was something that was important as step 1 here. Number 2, we've spoken about, but the interest rate at the same time that they may have had a slowdown, the interest rates climbed. And we know that as the interest rates are climbing, their dollars that were available for sale for securities also would have gone down in value. As a result of that, SVB needed to come and announce formally that they were selling some of their own securities to meet the customer withdrawal requests. And that's when we started seeing light of this. As that caught wind, there had a price drop of about 60%. So now not only did the people that happened to have read that that notice and the memo and the letter associated with it, but everybody else is catching wind that something's happening with this particular bank. Customers start getting calls. Their chief investment officers or financial officers are going and start making a run on the bank to pull their money out. And a lot of them do this all at the same time. You saw the line probably in the photos or the videos associated with that. Eventually, the regulators step in and the FDIC comes in and closes that bank. First time we've seen this in quite some time. It has happened before. We've all seen it. It's just been a while. So it's something that we need to think about in terms of how it applies to you. Okay, so over the weekend, we were really considering what was going to be the lashback of all this. And that was a big part of the concern as we were thinking, where does this end? What's the trickle-down effect? How much of a contagion would this be? This could be devastating, really, if these banks, if these clients of the bank were not able to pay their payroll, and just the trickle-down effect associated with that could have been devastating. Luckily, the government came in and they said that they announced it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. This was a very, very good sense of relief. The idea here is that hopefully it will stop people from just running to the bank to pull their money out and doing that at a broad level. I know it's tendency to still see that at some institutions, but as a whole, I think this will slow down the concern in a big manner, and we'll see how that plays out. Okay, so that's the general primer. Now, how does this affect you and your investments is going to be the next question. Well, for starters, obviously, in the midst of all this, because the S&P 500 is composed to some degree of financials and banks, we saw the markets dropping last week here by about 4.6. That wasn't the only reason, but it was going to be one of the factors. So we take a closer look at just the financial sector. We saw this was about 10%. That was going into this morning as well. So one of the first things that I would think of if I were you, if as a client or investor, which I am myself, and so if I was in your shoes, I would want to know, okay, what sort of exposure do I have to these sectors to see how much and when and where are they positioned, so I have an idea of what my risk might be. So for starters, we're going to take a look and see what percentage of the S&P 500 is going to be in the financial sector. And it's about 11.7%. So luckily, it's not going to be like the tech sector that's going to be closer to 27%, but it's still more than 10% number. So let's take a closer look, though, because not every financial is a bank. So as you go into the financials and dig down a little bit deeper, we can see that approximately 4% of the financials, or not of the financials, of the S&P 500 are going to be bank related. And then the bigger concern really weren't the big institutions, but these smaller regional institutions that may not be able to stomach the withdrawals of a mass population coming in and making a run on their bank. So we want to take a closer look at what percentage exposure of the S&P 500 might be in more smaller regional banks as opposed to the larger banks. And that's, you can see, somewhere around 1%. Now, these aren't exact figures. These are literally by going through the list of the companies in the S&P 500 and just extracting the ones that have the bank in their names or bank holding companies. But there are some other companies that also do some banking, but they're not pure banks. So just to give you an example. Okay, now that's the S&P 500. So that gives you hopefully a little bit of peace of mind and confidence to say, well, gee whiz, this whole thing is less than 1% of something I really need to be worried about, because I'm not really concerned about the Bank of Americas and the JP Morgans, Chase JP Morgans, for instance, as much, but the smaller firms. But that's going to be the S&P 500. What if you have other types of investments, let's just say for dividends, for instance? And I just use this as an example with Schwab ETF. They're a decent dividend ETF. And an example here, you can take a look at, you can see in order to get that dividend, they're investing a higher percentage in banks, or financials rather, about 20%. So that's quite a bit higher. And this is the sort of reason why it's important to know what you own and where you own them. And if not, to speak to your advisors about this. So from that, what I would want to know if I were you, so I did the research for you so you don't have to, if you own something like that, the bank exposure to that same investment was about 8%. Okay, so that isn't by itself still going to be overly problematic, but it is going to be higher than what you might have in the S&P 500 for a different reason, obviously, for dividends as opposed to potentially for growth. But even at an 8% clip, depending on how much of your money you have in this one investment, could be a very small percentage on something that you would need to worry about, at least in terms of defaulting or getting shut down from the FDIC or regulators or anything like that. There's still going to be the volatility risk, of course. You're not going to get away from that on the rest of the account or the investment. But in general, hopefully this is starting to make you feel at ease. There's a much smaller percentage, but it is important to consider what type of investments you own. Okay, now for our investors, the ones that are investing, and by the way, we use a number of different very large institutional firms, whether it be American funds or whether it be Goldman Sachs or a number of different companies. You guys know this. But in addition to this, we've also been running our own boutique strategy in order to try to provide value in places where I felt that there was value that was missing. I'm going to share with you 3 of those strategies. First one I'm going to go into is our dividend income and growth strategy. And we're going to look at a comparable exposure to see what that looks like. Many of you have this. In order to get dividends on this, getting a dividend of somewhere potentially between 3 to 4% dividend exposure, as opposed to about 1.6% with the S&P 500. So it's for income for sure. But we want to take a look at the exposure in comparison to, let's say, another dividend type of investment. You can see that here. So as opposed to the Schwab dividend play, ours is about 12%, a little bit more in line with the S&P 500, and about 3.2% in the banking sector. Again, a very small percentage. Now let's drill down on this a little bit more to see. Look, first of all, it's just going to be a 3.2% exposure, not the entire portfolio. And of that 3.2% exposure, you'll be happy to know there's no SVB, Silicon Valley Bank. It's just the largest bank, one of the largest banks on the planet. So hopefully this makes you feel a little bit better. In terms of some of our defensive strategies that we would utilize, and I'll share with you 2 examples, both of our index strategies. The first one is going to be, well, actually, let me back up and share with you a little bit more about the defensive mechanism and how it works. In general, we have other strategies that we'll sit on as buy and hold strategies, but I've always believed that a combination of passive and active strategies are going to be a best solution, because we never know when we're going to be on a long-term bull run, and we never know when we're going to be on a long-term bear run. So in order to have a combination of those working for retirement purposes, I think are very important, so that you're not spiraling your dollars and selling as the shares are dropping over too long of a period of time and just saying, let's just buy and hope, or sit and hold, the old cliche, just hold on, everything's going to be okay. So I feel very strongly about this, but we can discuss this a little bit later. You may or may not have these strategies, but the simplicity of it is that if we do have a defensive strategy, you're going to be times when you're either going to be in scenario A and all the indicators are positive and we're going to be 100% invested in the markets, or scenario B, where we move into a bear market mode and you may have a less than 100% exposure in the markets. So for now, just to give you an example of what this might look like, is you can see that at least one of our indicators here, our main U.S. equity indicator, and we use 2 of them, one's not on this chart, but has been negative since March 4th. Of 2022, not even this year. This has been negative for over a year now. And so that's caused us to have some caution tones on this for quite some time. Now you might be thinking, wow, that's a long period of time to be in a defensive mode. And I'll share with you a little bit more of a history of what this may have looked like, because this is not something that's bouncing in and out on a regular basis. Just something that's suggesting that when it seems to be like there's a larger degree of risk in the markets, that we're just going to have a portion of the risk reduced within your accounts that have this particular strategy. And to share that with you, you can see that the indicator last time it was negative here would have been January 15th of 2016. So it's been quite some time. There has been a lot of volatility, stayed with it all the way through. And to be clear, this is not the markets. This is just the indicator. This would have been based upon a number of different metrics when the indicator was negative or when it went back to positive. Right now it's negative. And I'm going to add the bottom half of the screen now, which is an example of how this would have translated into the S&P 500. So as you see the gray bars from top to bottom, they sort of correspond with both charts. And you can see, I'll walk you through it here, but this is going to be essentially the 2000, October 13th, when the indicator went negative. According to that, this is when the S&P 500 we would have recognized that indicator here in 2000 to have been negative and missed out likely, if you're utilizing this indicator during that time, a significant portion of that market decline. And then the indicator went positive in the market, and then we would have been back in the markets to participate in some of that increase over that period of time. That's the easiest part of the chart to look at it. I'm going to go to the right-hand side just to give you a little bit of what that looked like recently. When March 4th, 2022, that indicator went to negative. So in the S&P 500, you can see missed out on a significant portion of the decline, but also missed out on some of the increase that took place earlier this year. And so we're perfectly okay with that because it still seems or has seemed like there's been a higher degree of risk in the markets than would make us comfortable being all in with the entire portfolio for somebody who is retired and doesn't want to have to go back to work. So what has taken place as a result of the market decline, in addition to regular market concerns, has now been this SVB crisis. Okay, so if we look at one of the strategies in here, now I'm going to drill down a little bit deeper. So that was just the indicators themselves. The most aggressive of these indicators, and these go in terms of risk, from lowest risk to highest risk meaning that if all the indicators are positive, you're going to have 100% of the dollars that are going to be in equities or stocks. So let's start there. And you can see that as of now, and this has been like this for a while, but there's only been not even a 50% exposure to equities. In fact, a little bit less, 45, and a little bit more to money markets. Perfectly happy sitting collecting a 4% yield on a money market account right now with no risk on the downside from a stock market perspective. So that's what's been happening here, just to share with you. So right off the bat, even if you have exposure to the S&P 500 here, it's only going to be half of what you normally would have had if you had been fully invested. So that was my main point that I wanted to get to. As you can see, there's still about 11.6% in financials, but on only about half of the money that was in this strategy, because the rest of the money is in cash. And so you can see there's nothing specific that's going to be to any particular bank or a bank fund or anything like that that is associated with this particular strategy. The other strategy is a little bit more of a conservative allocation strategy. It's not as concentrated. As we look into that, it's also defensive, however. And if this strategy was 100, if the markets were positive, the indicator was positive, then we would see 100% exposure to equities. This also has slightly under 50% exposure to equities. The rest of the dollars in a money market. Again, perfectly happy collecting 4% while we have it there. It's ranged up from 3 to 4% for quite some time, last several months at least. And so we're happy to have that there. As we drill down into this, we see there's a little bit less exposure to equity, to financials, about 9.6%. But remember, a little bit less than half is actually in the equities that are going to even contain the financials in the first place. And the rest of it is going to be a little bit more concentrated on energy and materials for right now. Again, no specific bank sector or anything like that, mostly energy and natural resources. Okay, so that gives you a little bit. Hopefully the point there is that, look, there's very little, if any, exposure to the financials and or banking, and the most concern from there is going to be the regional smaller banks, if at all. So hopefully that puts you a little bit more at ease, and then we'll cover the other element now. It's like, what can I take away as an action plan to protect myself in the future? The first is, think of this as a wake-up call. Now, I know some of you that are watching, some of you are clients. I know you have more than 250 at the bank, and there's a chunk of you. It's like the earthquake we haven't had in a while, and you want to know about getting your kit and everything for the earthquake before it happens. Luckily, this has now been, because of the government stepping in, a little bit more of a tremor that didn't turn into the big one. So I would think about this as a financial wake-up call, and just consider the fact that if you have more than $250,000 at any bank, first of all, start thinking about moving those dollars to a different large bank. And the second thing is to consider the different types of ownership categories you have within the bank, because there are ways to get additional coverage than $250,000 within that single institution. And I'll share with you what that looks like on the next page. But before I move on from this page, it's also important to consider that if you have, let's just say you have one account in your own name, and it's not an IRA or anything, and you have another account also in your own name, maybe one's a savings and one is a checking account, those accounts will be added together because it's the same registration and you're still the same person. So you can't have 250 in each of those types of accounts, and consider them as separate accounts, each getting the coverage. So keep that in mind. However, there are other types of accounts where it works exactly the opposite, where the fact that it's a different type of an account or category of an account will give you yet another potential $250,000 in coverage. So a lot of times people forget this and they move dollars out arbitrarily when they don't need to. Safe best practice still, however, I would say, is to still keep no more than 250 at any institution, unless you have so much money that you really just need to put more in. Then you want to go by these rules. So for instance, if you have two people on an account, then you're going to have $250,000 per person, per owner that's going to be in the account. And so that's going to work really well. Now, obviously, don't go just finding any person that happens to be randomly walking down the street to add them to your account just for the coverage, right? You want to make sure there's somebody you care about, likely your spouse or partner. So the second is going to be things like IRA accounts. If you have an IRA account and then a non-IRA account, those will each get separate coverage. The one that's a little bit tricky, and I love that it provides this additional coverage, but it's not going to be if you have a living trust, for instance, and you have 3 beneficiaries on that living trust and they're each different than each other, then that coverage will extend to each of the beneficiaries. So potentially $750,000 of coverage rather than just $250,000. So there's a few more here. The information is here, fdic.gov. Feel free to look that up, and we'll probably include it in the email to you clients as well as you're getting this. Okay, the other thing to think of is, what about the dollars that you have at your brokerage firms? The brokerage firms are not a bank, so they're not going to be generally FDIC insured the same way that a bank does. However, you can still buy bank assets within a brokerage account, depending on which institution you're utilizing. And so you could potentially have additional coverage there as well, also pertaining to maybe some of the cash you have on hand. So this is an example of how it works at TD Ameritrade for now. And it's something that regardless of which company you're working with, you want to have a good understanding as far as how this particular works. But $250,000, and again, there's ways to get additional protection there. The third is going to be to remember, if you have a brokerage account, really, there's separate insurance for that. That's the SIPC protection. This is not the same government agency for the banks. This is specifically for brokerage accounts. This is generally going to protect you for $100,000, which used to be the limit for FDIC coverage, but $100,000 of cash and an additional $400,000 of securities generally. Okay, so you see that on most brokerage firms, the SIPC sign, that's essentially what that's referring to with the protection there. But in addition to that, some firms, like you see here with this TD Ameritrade, provide supplemental coverage beyond that combination of $500,000, which with this you see is $149.5 million worth of protection for securities and $2 million of protection for cash through a supplemental coverage, in this case provided by London Insure. So it's like an additional layer of protection, and that's comforting to know with whichever institution you're working with. So make sure you're working ideally with some of the big companies. The fourth is just to remember your own bond exposure. This should look familiar. It's partially what got SVB in trouble, but it can absolutely get an individual investor or retiree in trouble as well. If you haven't earmarked the money that you need properly, and you think that your bonds are more conservative and they're going to be there for you when you take the money out, if you haven't looked at your cash flow planning properly and you haven't bought the right types of bonds. So there's different ways to buy bonds. There's different reasons why you might buy them. You might buy them for preservation. You might buy it for income, and you might buy it for other strategies as well. So just keep in mind that if you're working with somebody who understands this, they're probably doing it for you. Feel free to ask questions about that. Consider utilizing an individual laddered bond portfolio if your accounts are over $250,000 worth. Rather than just an ETF or a bond fund or something like that as well. Okay, and 5, finally, is to stay focused on planning fundamentals. Last thing you want to do is avoid common and emotional behavior, like people that panicked and just sold on Friday or this morning just for kind of essentially made a run on their own investments as opposed to a run on the bank. You want to not buy high and sell low. You want to do the opposite, right? So make sure you have a plan. What's your plan not to give it all back? Ultimately, you want to be able to answer the one true question that truly matters: am I okay? If you're working with us, we have ways and things that we have thought of. We don't know when the next dip is going to be. We say this all the time. The next earthquake, we never would have guessed a pandemic, but that was going to be an example of a drop in the roller coaster here. We never would have guessed SVB this time. It's going to be something next time. And we have that built into your plan because we know it's going to happen. We have plans and we have investment solutions to take these things into consideration. So the first is to start and make sure you have a process. This is ours. All of our clients have been through it. We go through a very detailed process to understand and learn what's important to you, what your goals and objectives are. Then we review all of your financials to get a better idea to what your cash flow looks like and when you're going to need the money. And then we make a plan around that based upon your own time horizons. Then we use investments that are going to be suitable to each portion of that plan. And then we come back and we integrate the other elements of your financial plan, including maybe some of the tax planning or Roth conversion planning or estate planning or whatever might need to be done. And then we have a way to review and track and follow up to make sure that things are going to be in order for you, especially the things that you can control as opposed to the things that you can't control. So it's the progress that gets made. We utilize the bucket plan written by my friend Jason Smith here. This is something I used to do on a spreadsheet. We now just utilize a very simple bucket plan approach from a visual perspective. But the key here is understanding cash flow and when approximately you're going to need certain amounts of dollars and investing accordingly, rather than just taking everything in and putting in, say, I'm a moderate investor, so I'm going to invest everything in a 60-40 allocation. As we saw last year, even 60-40 allocations were down about 17% for the year because both stocks and bonds were down. And so if that was your strategy, you went in and sold everything at a decline just to get the cash flow that you needed. That is not financial planning for retirement. That is just simplicity to the point that is on the verge of either lazy or lack of knowledge. I don't know. Hopefully that's not the boat that you're in. If this is going to be your first time looking at this, you'll have an idea that your first part of your bucket, we call the now bucket, is basically going to be for your very, very safer and liquid dollars. This is where your bank CDs would come into play, very conservative money markets, anything that you could think of that your government treasuries, things like this, things you know you can count on. Dollars that you're going to need in the near future, 2 to 10 years potentially, are going to be more middle of the road. Maybe you're buying your laddered individual bonds here, your in maybe index annuities or something that won't go down in value, or even a very conservative investment allocation, potentially to generate some income for the next 2 to 10 years, maybe 15 years. And then the dollars that you aren't going to spend, you know you're not going to touch them for 10 or 15 years or longer. This is more along the lines as far as when you invest in the S&P 500, either maybe as a buy and hold strategy or a tax loss strategy, or you utilize some of the defensive strategies that can invest fully in the markets, more in equities, depending on your degree of risk and how much income and growth you need for this each time of your horizon. But this is also when you start thinking about the dollars that you might need for long-term medical expenses and the dollars that you're not going to spend during your lifetime, how they're going to pass on to your heirs so you're not just leaving a big tax IOU to the IRS. So ultimately, you want to think about your core 4 retirement items. And this is much different than your working years. During retirement, it's a combination. It's not just about the investments. It's investment planning, tax distribution planning, income planning, and estate planning. This combination is what we refer to as retirement wealth management. It's not just about the investments. It is a combination of looking at these things individually, but then holistically as well, because you can't make a change in one item today without it potentially affecting the other. Hopefully, the next time you see a bank closure, if you have these things in place, you're working with us. Hopefully now you know, if at all, you have very low exposure to any of the banks, especially the regionals. The portion that you do have exposure to is probably something that you're not going to need for 10 to 15 years or longer. We have laid out cash flow for you so that we know that that's something that you have enough to tap into when you need it. And next time we go through a crisis, you're going to be a little bit more at ease on this topic. So if you're still having questions and you're a client, we'll likely review this during our next meeting. Well, feel free to give us a call or drop us an email to your financial advisor that you're working with. We do have a new review system, so you'll be hearing from us soon if you haven't already. And if you're not a client, maybe this was passed on to you from one of our wonderful, beautiful clients, then we invite you to give us a call to answer any questions, especially if you're looking for a new financial advisory team. We'll spend some time to learn a little bit more about you. You can ask questions about us. Either way, we just want to help get your questions answered, even if that doesn't entail working with us to make sure you're headed in the right direction. So I hope this has been helpful. If this has been, like I said, don't keep us a secret, but feel free to pass this to somebody that has the same concerns. Ultimately, We want you to be a more reassured investor, consumer, allow you to be an even better steward of your money for yourself and your family. So please continue to invest wisely and live an even better life. Thanks for your attention. Take good care. We've been through other concerns. We'll get through this one, and we'll get through the next one as well. But we definitely don't like what's happening, but we're very aware of what's happening. We're not asleep at the wheel. We just wanted you to know. Thank you, everybody. Make it a great day. Bye-bye.